Hey guys, for more like this, don't forget to hit the subscribe, the like button, and the notification bell. Hey everybody, it's Kevin Wadsworth from NorthStarBadCharts.com, and what I'm about to show you is my summary, my chart that illustrates what I think is happening with the economy at the moment and what the evidence is suggesting. Now, as a scientist, I am trained to really only pay attention to evidence. There are a lot of theories out there about what's happening, a lot of stories, a lot of fundamental narratives that point to what is happening, and some of those carry quite a lot of credence, and many of them do in fact, but they don't really amount to anything unless the solid hard evidence is there to back it up. And what I'm here to show you is my view of the evidence about what has been happening over the last 50 years, what's happening right at the moment, and what I think it's going to lead to over the coming, let's say, sort of 5 to 10, 15, 20 years. So really through the next investment cycle. So what I'm going to do now is share my screen and share with you my thoughts. So just bear with me whilst I do that. I'm going to turn my camera off as well at the same time. So the screen sharing is now switched on, and I'm just going to switch the video camera off because you don't need to see me through all of this. Okay, so US government 10-year bond yields. So this is the US government 10-year yield bonds, and this is a chart that shows you what's been happening with the 10-year yield over the last 50 years. So in the introduction, I said that I was trying to illustrate what we've been seeing over the last 50 years and where we're going to be going. So this chart I put out several years ago now, I think probably back in around about 2019, so getting on for 4 years now. And what I spotted, what I noticed was that during the 1950s, the 10-year yield broke out from a resistance line, this red resistance line, and then broke above the overhead resistance line, which is this dotted black line here. And then the 10-year yields rose. Now, what you're looking at on the chart here is the debt to GDP in the red boxes and the Fed funds rate in the blue boxes. So the debt to GDP was dropping as the 10-year yield was rising. So the yields and the interest rates were able to rise because, or as a result of the fact that debt to GDP was falling. So debt serviceability remained, how can I put it, remained plausible. It was possible to service the debt because the debt to GDP was falling. Don't forget, during this period of the 1950s and 60s in particular, the US had a very strong economy, exporting oil all around the world, exporting motor vehicles, and all sorts of other things. The United States was a very strong global economy. So debt to GDP was falling, even though economic times were tough and inflation was ripping through the economy. Interest rates rose very, very sharply as a result of that, and eventually contained the problem. And what happened then is that the 10-year yield spent 40 years falling, okay? From 1980 to roughly 2020, the 10-year yield dropped. And you can see the problem developing here. This is what I spotted back in 2019 when I started looking at the figures. And it's why I called this red line the pain line. Now, this is the important bit to really get your head around and understand. Through this last 40-year period, the debt to GDP, far from falling, has been rising. So debt to GDP, 31%, 50%, 61%, then up to 90%, past 100%, and then up to 129%. Okay, so all of that was happening. So debt to GDP was rising, but that was okay because the Fed funds rate was falling. So the rising debt mountain and the rising debt mountain in comparison to GDP was manageable because the Fed funds rate was dropping. So the interest rates on that debt were so small that the debt was able to rise and the payments didn't become a problem. Okay, so I hope you're still with me on that. Now, what I then spotted was that this was a bullish, expanding, descending wedge. So in 2019, before the COVID pandemic hit, I'd suggested that this was a bullish descending wedge. And then in 2020, March of 2020, in fact, a little bit before, might have been a bit before that, but in any case, it was early 2020, this began to break to the downside. And we had this huge spike in many markets to the downside. And this was marking the end of the financial and economic regime as we know it. So everything since 1980 that we've become accustomed to ended when this false breakdown occurred. Now, a chart technician, you'll sometimes hear talking about false breakdowns. What that means is that the pattern was telling you that the price was going to go in a particular direction, but instead of going in that direction, in this case upwards, instead of going upwards, it broke to the downside. Now, when something breaks to the downside, it either collapses, because we've been going down for 40 years. So if this breaks to the downside and continues falling, it either collapses completely and ceases to exist effectively, or this is a false move. And when you get a false move, and of course, you know, this isn't a company that we're talking about. It's not a mining company. It's not going to go out of existence. We're talking about the US government bonds 10-year yield. So, you know, this can't go out of existence, is what I'm saying. And you can't be sub-zero forever. It's just not economically possible, or mathematically possible, I should say, perhaps. So I said with a good deal of confidence that this was a false breakdown at the time. When this broke down here, before it spiked all the way to the upside, I stated that this was a false breakdown because the technical chart made that the only feasible probability. There was no chance that this was going to continue down at these levels. And of course, we very quickly started to see the upside move, the upside breakout, and we had a move that took us right the way to the resistance line, and I called that the pain line. Why did I call it the pain line? Well, I called it the pain line because during this entire period, there was a very good reason that the 10-year yield was below that line. And that reason was to stop any pain, because if the 10-year yield crosses that threshold, the economy is going to start suffering pain. Now, I'm not an economist, so I wasn't prepared to say what kind of pain. All I knew at the time was that there was going to be huge economic problems should we cross that line, comparing events to the 1970s. But of course, we've got a bit of a catch-22 here now, because unlike the 1970s, where the bond yields rose and were able to keep rising because debt was dropping or debt to GDP was falling, we now have debt to GDP which has risen, and we're on the wrong side of the pain line. So we've got a serious problem here. And also notice, just might as well mention this, the 12-year moving average very rarely changes direction. It changed direction in the 1950s, it changed direction again in the 1980s and 90s, and it's changing direction again now. So having been falling all this time, the 12-year moving average is turning up. So something is happening, and something has indeed happened, that has completely changed the investment background. So if you're expecting things to work out in the way that they have done over the last 40 years, you're very much mistaken, and you need to rethink and reconsider what your expectations are. So the 10-year yield has broken out and it is now back testing the resistance line. It was a resistance line, this dotted black line. It's now a support line. Now, something else very, very interesting has happened at the same time as this, and I'm talking here about the money supply. Both the M1 and M2 money supply have begun to drop. Now, this is on the non-log scale, so that you can see the drop more clearly. If I put these on the log scale, I'll just do it for both of them. You can see that during the 1970s, if I go back, the money supply was rising at the same time as the 10-year yield was rising. So don't let anyone tell you that rising money supply means that the yields have to come down and the interest rates come down, because I'm not an economist, so I actually looked this up, and I looked up the official line on what should happen if money supply rises. And according to everything that I've read, when money supply rises, then interest rates should come down, and when money supply drops, interest rates should drop. So don't let anyone tell you that a rising money supply precludes rising rates and rising yields. It doesn't, because we can see clearly that in the 1970s, money supply rising did not prevent yields from rising and interest rates from rising. I think there's some kind of theory out there that says if you increase money supply, then interest rates can come down. Well, that is not true, demonstrably not true. So unless money supply is going to carry on falling, and call me a cynic, but I really don't believe that money supply is going to carry on falling. At some point, the money supply is going to have to start increasing again. And as money supply starts to increase, I expect the yields to continue to increase and interest rates to continue to increase. That is a big problem when you've got debt to GDP north of 120, 130%. In addition to that, and what I also want to show you is what happens to the stock market and what happens to gold during these sorts of times. So I will just move the chart up so that I can expand the stock market view for you. That's this one down here. So during the let's go back a little bit, and this is the stock market versus inflation. So this is SPX versus inflation. So during that entire period, during the 1960s, from let's say 1968 to 1990, so there's a 22-year period there where the stock market went nowhere versus inflation. Once it peaked, it came all the way down from 1969 all the way down to, let's say, 1982. So that's 13 years where the stock market lost to inflation. That entire period that rates and yields were rising, the stock market lost to inflation. It wasn't until 1982 that it would have made a good entry point, because the stock market began to gain versus inflation. Okay, what did gold do during that same period? Well, I think most of you probably realize that once gold came, the US dollar came off the gold standard, gold rapidly moved up many hundreds of percent. In fact, from somewhere down below $100 to somewhere up around $800. So many hundreds of percent for gold, and it vastly outperformed the stock market during that period. As I say, the stock market only began to make gains after gold had peaked. Once gold had peaked, then that was the time to rotate into the stock market, and you can see that as the S&P began to gain versus inflation and gold began to decline. So that's all very interesting, but what about today? So what's happening now? As you can see, as M1 and M2 have been declining, and I believe are set to resume their upwards trajectory, the stock market versus inflation has formed a bearish, rising, expanding wedge of epic proportions. And we had what I would call here, a parabolic blow-off top, in fact, because this upper resistance line, if you draw it perhaps a little bit more conservatively, you can see a very clear blow-off above the resistance line, and the S&P tried to accelerate even further away from the expanding wedge here, and it failed. And not only that, we're broken down below the support line, and we have back tested that support line. So it's my belief that the S&P versus inflation, regardless of what happens to the nominal value of the S&P versus inflation is highly likely to take 2 decades, at least 2 decades, to get back to its previous highs. So nominally, the S&P could go back to its previous highs of 4,800 or whatever it was, even make slight nominal new highs, but versus inflation, it just ain't going to happen. And in fact, I very much doubt it's even going to do that, because the technical chart here is highly suggestive of a near-term large fall for the stock market, particularly versus inflation. Gold, you'll have noticed, is doing something very, very bullish. It's built out a cup and handle pattern over the last 12 years or so, since 2011, very large cup, and a handle here that's taken at least 2.5 years to build out. And we're just starting to show signs of breaking out from that handle. So put all of this together and do understand what I'm saying to you, because it's going to be very, very important for your trading investing decisions. A capital rotation appears to be underway here, and I remain open-minded and unbiased, because if the evidence begins to appear that suggests stock markets are going to do great and precious metals are not going to do great and commodities are going to start to suffer, then I'll change my view and I'll update the forecast. But the evidence, the scientific evidence as it stands at the moment, suggests that we have major issues with the US economy, major problems with debt obligations, major problems with controlling inflation. And anyone that suggests inflation is finished now and that we're heading for a massive deflationary problems, I, at the moment, struggle to square that with what the technical analysis is suggesting. We appear to be heading towards a problem with recession, but not a deflationary recession, a recession where stagflation is the order of the day, where inflation is stubbornly high and the economy is in a serious problem. But this serious problem is something that we've not encountered before because of the debt to GDP issue. If we can't increase GDP dramatically, then we've got a very serious problem on our hands here, and a problem that I can't think of a mathematical way of solving. As a mathematician and a scientist myself and a statistician, I struggle to see that, absent a huge increase in GDP, that there is a clear way out of this. There are several unpleasant ways out of this. There are a number of very serious and very unpleasant ways out of this problem, which I don't even really want to begin contemplating. But certainly the charts underneath here that I've been showing you relating to the stock markets and gold tell their own story. And also remember that between 2000 and 2012, gold rose in excess of 600%. So if that were to happen today, you'd be talking about gold north of $10,000 within probably a handful of years, perhaps by the end of this decade. So $10,000 gold and silver in triple digits is entirely possible by the end of this decade. So bear that in mind when you are considering your trading and investing decisions. And I will leave that thought with you. I think it's probably a good place to end this podcast now, because I've probably scared you more than enough. I might have shown a few people something that they haven't seen before, and I hope I hope this message really sort of I hope this message really helps a lot of people to understand the seriousness of the predicament that we're in. It's not something to be taken lightly, and I think it's going to affect our future to a very large degree. The mainstream media are going to try and put a spin on this. The politicians, in conjunction with mainstream media, will put all sorts of spins on this. But make no mistake, this is the result of 40 years or more of terrible economic policy by those in power in the United States. Whether it's intentional or not, I have no idea. But the decisions that have led to this point are absolutely appalling, short-sighted, and I don't know what they were designed to achieve, except the destruction of living standards and the complete destruction of the US dollar and global reserve currency status. I'm afraid the United States seems to have brought this entire problem upon itself, through the inability to think beyond the 4-year election cycle. And that's where I'm going to end the podcast. And thanks for watching, thanks for listening, and speak to you again very soon.